Traditional investments, like bonds and CDs, they're very traditional. Reliable payments on a reliable schedule. But sometimes reliability isn't enough. Sometimes you want more, as in more income. The chance to earn more money is the reason you're investing in the first place. There's an investment that can give you those higher payments. It's called an Auto Callable Note. As long as its underlier stays within a fixed range, you'll get coupons that are higher than traditional fixed income products. Below that range, and you could miss some payments. Above that range, the trade gets called, automatically called, according to terms that were laid out before the trade began. There are some other things you'll need to know about the note, such as the risk to principal, and we'll talk about those in a moment. So let's see that in action. Here's that fixed range we talked about before. Here at the top is the auto call level. If the underlier is at or above that line on observation day, the trade ends. It gets called. The issuer will pay back your principal, along with your final coupon. And at the bottom is the coupon barrier level. If the underlier is below this line on observation day, you won't get a coupon for that period. And if the underlier is in between those lines, you'll get your coupon and the trade will continue. Now, since this is a note, you'll have a coupon rate. And like all structured investments, auto callables have a fixed term, typically 3 to 10 years. There's one other number you need to know, the buffer level. If your note goes to term and the underlier closes below that level on the maturity date, you'd lose some or even all of your principal. Now that's an important thing to know about auto callables. There is risk to your principal. The amount you could lose is determined by what's called a trigger buffer. We'll talk more about it soon. Okay, let's take an example. We'll use the S&P 500 as the underlier. The term is 10 years with quarterly coupon periods. Our auto call level is 100%. So on observation days, if the underlier is at its original level or above it, the trade will be called. The coupon barrier level is 70%, and the buffer level is 50%. If the trade goes to maturity and the underlier is less than half of its original value, you could lose some or all of your principal. Finally, the coupon rate is 8% a year, paid quarterly. So the trade begins. Let's say the S&P is at 1,000 on the trade date. 70% of that is 700. So that's the number you'll have to match or beat to get your payment. When we hit an observation date, there are 3 things that can happen. Number 1, the S&P is below the coupon barrier. You won't get your coupon, but the trade will continue to the next observation date. Number 2, the S&P is above the coupon barrier, but below the auto call level. Remember, the annual coupon rate is 8%, so you get your 2% quarterly coupon, and the trade continues. Number 3, the S&P is at or above the auto call level. The trade ends. You get all your principal back, along with your 2% quarterly coupon. As long as the trade doesn't get called, this process repeats at the end of every coupon period. It could end on any observation date prior to maturity if the underlier beats the auto call level. But let's say this note goes to term. At maturity, if the underlier is above the coupon barrier, you'll get your coupon payment just like any other observation date. But more importantly, this is where your buffer level comes into play. We'll switch to the payout graph to show how it works. Remember, this line represents the performance of your underlier at maturity, and this line represents the payout on your note at maturity. This line represents your buffer level. If the underlier closes at or above this point, you'll be fine. Because of the buffer, you'd get all your principal back, although you won't get any additional returns if the underlier goes up. But if your underlier has dropped below the buffer level, you'll take losses that match the performance of your underlier 1-to-1. Here are some of the ways you can customize your auto callable note. If you want a higher coupon rate, you could push out your maturity date, just like with most traditional fixed income investments. Or you can raise your coupon barrier. That means more risk. A higher barrier is harder to beat on observation day. But if you do stay above that line, you could increase the size of your coupon payments overall. So you'd have to be confident about your view of the performance of the underlier. Or you could go in the opposite direction. You could protect your coupon payments from risk. Auto callables have an option called memory, and it actually gives you a second shot at earning coupons you missed out in the past. Here's how it works. Let's say your auto callable has been paying coupons, but then the underlier drops, and it ends below the coupon barrier for one or more periods. You won't get those payments. But then, let's say your underlier rises, and it ends above the coupon barrier. Of course, you'll get your coupon for that period. But with memory, you'll also get payments for those periods you missed, back until the last time you finished above the coupon barrier. So memory lets you make up for past low performance. But to get it, you'd have to lower your coupon rate. So for the example we gave before, the 8% annual rate might drop to, say, 6% with memory. Auto callable notes carry many of the same risks as other income-oriented structured investments. First, you're not guaranteed to get a coupon. If your underlier is performing poorly, you may miss out on some payments. Second, they don't guarantee 100% return on your principal. If your underlier is below the buffer level at maturity, you could take losses in line with the performance of your underlier. Third, you won't earn any dividends, and even if your underlier performs well, you won't participate in any upside. You can only receive your initial principal and your final coupon at maturity. Fourth, these are buy and hold products. If you sell your notes prior to maturity, you may lose some principal, even if the underlier has gone up since the beginning of your trade. And you should know that auto callable notes aren't liquid in the same way the underlying investments are. Although the trading arm of your issuing firm usually will buy the notes back, it has no legal obligation to do so. Fifth, auto callables are subject to the credit risk of the issuer. And finally, if your note has been called, you may not be able to reinvest in a trade with similar terms. Because they put your principal at risk, auto callable notes could be seen as fitting into the equity side of your portfolio, but they're typically used on the fixed income side of the portfolio. They have the potential to deliver much higher income, but they come with risk to your coupons and your principal. So you shouldn't use them to replace investments where you're dependent on regular coupons or where you can't afford any capital losses. But if you're looking for the chance to get more income from your fixed income investments, then auto callables might be a way to make your coupons grow.